Hi, hello, and welcome to the market update from 12th to 16th August 2024. Let's start with the usual format from the world economy. News coming in from China that their unemployment rate has rose for the first time since the month of February at 5.2%. The industrial production rose slowly. It did rise, but it rose slowly at a rate of 5.1% Y on Y in the month of July as compared to 5.3% which was in the month of June. Retail sales also grew slightly more by 2.7% YOY in July as compared to 2% in the month of June. The investment in the real estate has dropped, as we all know that the Chinese economy was majorly an real estate economy, and the real estate investment had dropped by 10.2% YoY in the first 7 months of the year. US came out where US consumer price inflation increased by 2.9% in the month of July compared to 3% in the month of June. On month basis, the CPI number has increased by 0.2%. So the core CPI inflation, which excluded the index's more volatile food and energy components, it was at 3.2% in the month of July, matching the estimates of 3.2% and of July and June 3.2%. The unemployment rate rose for the fourth straight month in July, though it remained low at 4.3%. So overall, the situation in the US does show that there would be a rate cut happening in the next meeting, where the inflation price has come down by 2.9%, and the unemployment rate has also come down to 4.3%, which is something what the Feds were looking for a very long time. Another thing to look at is the US 10-year Treasury bond yield, which has come down a bit to 3.8 now for the last week. The last week, the fear of recession and the yen carry trade fears disappeared from the markets, and towards the end of the week, the markets gave up a cheer, and all the markets for the week ended up in positive. You can see that the European market, the Dow Jones, the S&P, they were up by 4%. The European markets were up by 2%. Indian market, the Nikkei, which had felt the largest brunt during the last few weeks, it was up by 8.6%. Indian market was up by 1%. The Swiss market was up by 3%. The Taiwanese market was up by 4%. So the overall market was in a cheerful mode towards the end of the week, and this could be seen in that the oil prices had come down. It started trading below $80 a barrel. The price of oil is now at $79.58 a barrel, slightly up by 0.15% from the last week. This is because the oil prices from there's a demand. OPEC countries are seeing that there's a lower demand forecast in the world. Gold as an asset did rise up significantly for the last week. We saw gold coming to 71.395 per 10 grams, which is 2.21%. FIIs did continue their selling activity. They sold about 8,616.43 crores in the Indian market, but it was lower as compared to the last few weeks that we've been seeing since the start of this month. And towards the end of the month, we were seeing that the buying activity has resumed into the Indian market for the FIIs. DI has also bought close to 10,560 crore worth of equities. If we look at India came out with a CPI inflation number. The major 4 points out of which I called as Indian inflation moderated sharply to 3.5% in the month of June. In the month of July, from 5.1% in the month of June. Which was largely on account of a favorable base of the last year. The core inflation remained largely benign, rising marginally to 3.4% in the month of July, up from 3.1% in reflecting the recent hikes in telecom tariffs and upward revision of the fuel pricing in certain states. The food inflation, which has been high at around 8%, this was led by cereals, 8.8, which were up by 8.8%, pulses 16.1%, and the vegetables 29.3%. The RBI is still remains cautious on this front, but of course there's a satisfactory monsoon which may lead up to the moderation in the food prices. Even though after that the RBI had revised the inflation projection for Q2, that is the quarter that we are in currently, to 4.4%. That's 60 bips higher than its previous projection. If we look at the Indian IIP, Indian Index of Industrial Production, actually moderated to 4.2% in the month of June, from a 7-month high of 6.2% in the previous month, that is in the month of May. This was primarily due to the slowdown in manufacturing and the electricity. The growth output in the manufacturing had slowed down to 2.6%. Following a very good growth that we had seen in 5% in the last month in the manufacturing sector. The consumption scenario, on the other hand, was painted a very mixed picture, as the output of the consumer durables increased by 8.6% on the one hand, while the output of the new non-durables contracted by 1.4%. So consumption as a theme was something contradictory on the both the ends of the consumer durable and the consumer non-durable side. The metals, the output of the basic metals which has a highest weight index of 12.8%, also grew by 4.9%. This was lower as compared to the month of May, which was at 8.3%. Among the export and intensive components, output of the textile remained in the contraction for the fourth consecutive month, with a decline to 1.7% in the month of June. Leather and related product also contracted by 3.9% as compared to the growth of 1.3% in the previous month. Growth in the output of the wearing apparel slowed in to 2.2% versus 9.8% in the month of May. So let's see overall impact on the markets. We saw that the global markets towards the end of the week came positive. So that was also reflected in the Nifty index. In our index performances, Sensex closed by 0.9%, largely because of backed by the global factors, and definitely some of the FIIs returning into the market. Nifty Bank was flattish, close to 0.06%. Nifty Mid Cap was up by 0.8%. Nifty Small Cap was again flattish at 0.14%. So we look at the how the valuations on the valuation front. If we look at the PE valuation, the Nifty 50 trailing PE has reached 22.8%, just above 2 years average and below 5 years average. Nifty Mid Cap 150 trailing PE is at 43.1, which is at 2 years and 5 years high. Nifty Small Cap 100 trailing PE is at 28.9, nearly 2-year high and just above the 5 years average. The Buffet indicator, which indicates the total market cap to the GDP, is still showing that the market is modestly overvalued. So overall, the markets doesn't look cheap at this point of time. If you look at the Indian bond markets, which have been trading, the 10-year treasury bond yield was somewhere about 7%. The yield curves in the short term, medium term, and long terms were more or less flat. So that was all from my side on the market and the economic update from the world and the Indian economy. Hope you like the video. Do share, subscribe to our channel so that you can get these updates regularly on weekly basis.